Welcome to our webinar today, Shelf Intelligence, the Revenue Imperative for Modern Retail. My name is Greg Busick. I'm Chief AI, that's easy for me to say, President and Chief AI Officer for Group. And with me today is Carl Mims from IHL. And Christian, go ahead and introduce yourself.
Yeah, my name is Christian Vlöckmeyer. I'm the CTO and co-founder at Scandit, a smart data capture company.
Super. Well, thanks so much, guys. And thanks for joining, everybody. So a little bit of housekeeping as we get started. First of all, I want to thank Scandit for making this content available. Some background. This is an annual study we do with Chain Store that we've been doing for 22 years. And in this, we've also added some questions regarding shelf intelligence, and that's what we're going to be presenting today. And we're making this part available thanks to the partnership with Scandit today. We don't want to do this as just one-way street. Please, if you can, we're on the right side, you will see chat, and that chat will allow for things to for you to share where you're from, what's your favorite team, are you a soccer fan or football, European style, are you American style, who's your team? Pro, college. I'm a big Buckeye for those of you guys that know my team here. Carl's a big Alabama fan. They're smoking cigars after beating Tennessee this weekend. So trash talk about the technology, talk about the slides. We want to make this as interactive as possible. This is also where you can add questions that you would like us to answer as we go through this. And one more housekeeping item. If you have not been on a recent webinar, we are providing a new analyst that we have released, the IHL analyst, which is basically a clone of me, 30 years of experience that can coach you through, particularly for startups, those companies that can't afford to do an analyst relationship and spend multiple thousands of dollars to do that. We put an AI version of me where you can ask questions. It can coach you through presentation, account planning, all those fun things. This new IHL analyst is on our website. You can use the QR code here as well, but it's getting access to our knowledge, our data. It has our Sophia data, installs, when things were installed, what's the timing of that. It has all that information in there. So we wanted to let you guys know about it first. So thank you so much for joining today. And with that, we're going to turn the cameras off and jump into the actual content here. So always like to start wide and narrow down things when it comes to the economy. So briefly looking at the EU, you want to look at this data here. And quite honestly, as you look at the data per country, if we go, Germany's seen growth, however, it's not as fast as inflation. Same with the EU. France is negative prior to inflation included. Spain and Poland are the only two EU countries listed here, and Hungary just barely, that surpass the inflation rate. So retail overall is down on a per unit basis when you look at the EU. China is at 3.3%. Their inflation is flat, okay? So they're in a deflationary period in many ways. Now, 3.3% sounds great. However, in China, you generally need to be about 5 to 6% to go with the population growth to be a positive environment for that environment. India is booming. Same with Vietnam. In Asia, there, Japan is negative. They had 42 consecutive months of increased sales. With rising wages, but that for the first month in August, they actually went negative for retail growth on a year-to-year basis. Once again, I mentioned Vietnam being the star. South Korea is struggling. A lot of the tariff stuff have hit South Korea in a big way. That's filtering through their economy, not so much in Vietnam, though, right now. Australia has been seeing great growth for the last 18 months, quite honestly, very solid growth. The new deal announced yesterday with the United States on rare earth magnets and rare earth materials, minerals, is a big deal and should be a huge boom to Australia's economy as we move forward. Latin and South America, Brazil is struggling, are moving more and more towards China with their trade. Their trade was up 20% in August. And one of the things that we want to factor in when we go deeper into China, you'll see that this divesting away from the U.S. is a very big deal in China when it comes to their trade relationships. Mexico, 2.4%. That is basically about where inflation is. So essentially flat that. And then Canada up 4%. A lot of domestic there, a lot of homegrown growth and people doing that. Certainly when it comes to things like wood and timber, fuel and gas, those have been positive for Canada there overall, helping to drive incomes and retail sales. Inflation wise, let's start with the UK. UK is running around 4% inflation overall with the core. If you look at this, it shows you the different items specifically there. So I'm sorry, the core is goods is the lowest one. That's the least inflation. Core is the red line there. So that puts you at about 4%, which is higher than pretty much anybody that we're going to talk at in detail here in terms of inflation. So that's obviously impacting. Sales volume is up. It's still positive there in Great Britain, but it's below, once again, the inflation rate, the growth that is in play there. So a lot of change happening in Great Britain. The fact that they've got a trade agreement with the U.S. now in principle is a positive there, but so much of the economy there is related to their internal, what's going on internally within the UK, as well as their trade with the EU. That is affecting and slowing things down as we go forward. As I look at the EU overall, inflation is a little lower there. If you look at the overall inflation, is about 2.2%. Energy being the big part that's down, as well as the non-energy industrial goods and services. Your food, as well as your core and your services, up about 3%. So they're higher than the overall inflation rate. Overall, we're looking at 2.2% inflation for the UK. For the EU. We saw a big slowdown in growth in the EU come August of this year after seeing pretty strong results that were beating inflation for the last several months. This is the first time it went negative for the EU in terms of retail sales against inflation. The EU is Estonia, Croatia, Slovakia, etc. on down, and you see the growth area overall, 0.2% overall, but some of those are very much below that 2.2%. Greece, Italy, France, etc. are below that 2.2% number overall for inflation. So let's move to China real quick. So China, the only reason I show this chart is to show this last at the very right here, our last quarter or last month in that month. You see a sharp reduction. You see a sharp reduction there in investment, fixed asset investment. This is pretty critical when you look at China as a retail business and what's happening. So although we're seeing exports grow overall, although we're seeing other things grow overall, the actual fixed asset investment that has boomed in China for years. This is where the shopping malls and the bridges and all that stuff, where they overspent in many cases. This is slowing down dramatically, and it's been more about where do they use their production for other economies other than the U.S. As we tend to as we're decoupling here with China on that. And this is very critical, very important to think through this as an engineering country. This investment drives employment, and this investment drives consumer opinion of the economy in China. And this is a big deal. There is a wonderful new book out called Breakneck. I think Dan Wang is the author about China. That's really fascinating. And it really goes through and bucks some of the myths that we have in the United States about China and how China is as an economy. There. In fact, in many ways, they're more entrepreneurial than we are in the United States. And you wouldn't think that. You think everything's from the States coming down. It's not that way. And it's a wonderful book with some great stories and anecdotes about what's really happening throughout the country. That being said, let's talk about overall stuff. So retail sales rose 3% year on year in September. Sounds good. I went flat or negative deflation there. That's a positive, but generally 5% keeps up with the birth rate in China. The big difference, and this is where the confidence comes in, is a sharp reduction in home appliance sales. We literally saw a 22% drop from where home appliance sales were in 2Q. So a dramatic drop in appliance sales, which means people are not going after homes, et cetera, despite, as you'll see later, in the reduced prices that are happening. And this is where that home piece just floods into retail so many different places, and it's not just the U.S. Despite the U.S. slowdown, the exports remain robust. Brazil, Africa in particular, industrial output is up 6.5%, but that private sector investment has slowed, and home prices are down in 60 of the 70 major cities for the 27th straight month that they've seen deflation in home prices. This is a big deal, and we'll get into it in the U.S., but you get into a home, you buy a bunch more stuff, that impacts retail, and it's fascinating what's going on. So, when you look at our news and you look at these negotiations in this trade war, we tend to see all the things that China has over us, but we also see the impacts that the U.S. has on China there as well. And so there's a two-way street for things, and neither is good. It'll, square it away at some point, but that just gives you a little bit more background. And once again, I highly recommend that book, Breakneck, out there. So let's look at the U.S. now. So the last data we had was for August from the government, had us at 2.9 or 3.1. If you follow us at all, my favorite inflation guide is Trueflation, which I'll get to. Should the Fed lower rates? Yes, the Fed should have lowered rates back in March of this year. The reason for that is multifold. Number one, the core items, the have-tos, we have been below 2% for quite a while. And one of the things that are driving inflation are insurance for cars, insurance for homes, college education, and what's the other one? The home price appreciation there, and insurance premiums, those things. Those are the driving factors. But when you get to the everyday, what do I need type thing, those have-tos are 1.7% in August. Now, if you strip out shelter, and the reason I say strip out shelter is because there is a made-up number that is admittedly 6 months behind in the government numbers. That is what they think you can sell your house for. And that makes up 40% of their factor that goes into that shelter number. So rents have been reducing nationwide. That number is not being reflected in this side of things. So if you strip out shelter, we are literally near 1%. And in some cases, we were negative in the April and May timeframe as to what was going on in the economy. So well beyond that 2% goal when it comes to inflation overall. So Trueflation indication 2.28%. That is a bit from where we were, but hovering around 2%. This is a Nielsen rating approach. There's a full market basket that they are updating on a daily basis. And this was yesterday at 2.28%. There. So we're hovering around 2.8, but nowhere near the 2.9 that is reflected in the government data. Gas prices are down. Gas prices are down about 12 cents the last 2 weeks in our webinar. The reason that's so critical is you have a situation where every penny sustained in America because of the amount of fuel we consume generates $2 billion more for something else. So as gas prices come down, that gets to a better retail economy for everybody. The concern is that diesel prices remain higher than we were a year ago. I still do not know the explanation of that, but that ripples through the economy as higher prices as well. So the savings in the regular fuel is being offset to some respects with the cost of diesel and the transportation there. So always keep an eye on fuel prices as that generates retail sales and what's going on. So some good news. I wanted to throw some good news in here with all this bad news that I've been throwing out. Prices are finally down quite significantly, 85% drop from the peak there. And but that being said, here are all the things putting pressure on inflation and on consumer wallets. The rise in auto insurance rates, 55%. Let's look at GDP. GDP shows up for consumer spending. That sounds great. We had a 3.8% increase in real GDP in the second quarter, and it shows that consumer spending is a part of that. The reality, though, is it is not retail driving that growth. If you look at the bottom line, the retail trade was actually negative in second quarter due to all the tariffs that came out. What drove the growth in GDP was finance and insurance, and then people continuing to eat out as we go in and look at what's going on with retail. So you get the wholesale trade, side of things that are also growing. So when you look at all of these things here in the second quarter that drove GDP, you see a lot of these things here are inflationary related to things rather than just pure consumption. And so that's the thing to keep in mind. And consumers are struggling. So the GDP looks good. It doesn't necessarily mean people are doing better. This just shows the overall change from quarter to quarter. So we had this big jump from Q1 to Q2 of this year. Those are what the headlines show you. But the reality of it is without data centers and the GDP growth from data centers in the first half of this year, we would have had 0.1% GDP growth. So everything related to AI and the AI build out is what's driving the overall economy right now. Without that, we would be negative about 3% in the economy. So keep that in mind as we think through the consumer, because if you're not participating in any way in this, it's hurting pretty big time. The last jobless claims we had came down. I don't know. I think these jobless claims with the government, I mean, they fired the director of the last one because of a statement of 1 million jobs. This is what the data says. I believe it's tougher out there than what this data is showing. We are not seeing a huge gap anymore between the number of openings and the number of people unemployed. It kind of matches up in terms of pure numbers. There's a major disconnect, though, when it comes to the jobs being created and the jobs that are open and skills of the people that are available for those jobs. And that's where the biggest issue is. For the first time, we are seeing that the bachelor's degree holders have a much higher underemployment rate, 61% underemployment rate for bachelor's degree holders. I've got 2 kids right now, graduated from college, both looking for jobs right now. Both did what they were supposed to do, STEM degrees or operational degrees type of thing, but both looking for jobs currently. It's really, really rough there. And so if you're talking about bubbles, the bubble's not the AI bubble. There's no AI bubble right now. We are still early second inning when it comes to the AI trade and all that sort of stuff. There will be a bubble that builds over time, but we're not in it right now. The big bubble that's out there is college. We've had this massive run up in college tuition and fees, 700% growth, literally 3.5 times that of the overall economy. And yet we're running into this situation where the people getting jobs are trying to get jobs. Only 30% of graduates in 2025 are working in a field related to their education. This is a stunning, stunning drop of the usefulness of college education in this new world. And that is impacting everything when it comes to the economy and what happens to the future of the economy and what happens with the future of retail related to that. So this is kind of where people feel that finding a suitable job that fits my qualification, negative continues to go up and the positive continues to go down here in this data from Payments Intelligence. This is our biggest concern with things. Job switchers as well now, the difference between what you could get job switching versus where you are today, that dropped to the same monthly growth rate. So we have quiet stayers now instead of quiet quitters, or people job hopping right now. People are staying in their jobs, and that makes it more and more difficult when it comes to those young new grads. And you can blame AI, but we are literally doing to new graduates right now in the economy what we did to manufacturing 25. We may be outsourcing it. We may be downsizing simply because of we wanted we overhired after COVID in a lot of fields, and we're blaming AI for it. But make no question, there is a crisis among our 20 to 30-year-olds, particularly those that got their college degrees right now, which is leading partially to more debt and the growth of debt. We're now at $18.4 trillion worth of household debt. Every sector has grown up, but it's been driving mostly by mortgage growth and things like student loans and other things. So it's driving up pretty high. The number of credit card accounts is going up significantly. I will tell you the general consumer, though, overall is not highly leveraged. We're not where we were like in 2008, where we have all these upside down loans, with the exception of autos. Those is becoming a major issue. I believe it's over 70% of people are upside down on their car values at the moment. Right now, meaning their car is not worth as much as they owe on the car. And the average loan is now 84 months for an auto loan there. So if we're looking at bubbles, college education and cars are the areas where we would see a bubble, so to speak, in the economy. Student loan balances and auto loans surpassed student loans here in 2025, literally for the first time since. Look at that last time, just coming out of the recessionary period. That's the last time we had auto loans above that. So that is a concern, and it's pressure on the consumer. Housing is a big issue. The affordability of housing and the number of homes that are available. When I was growing up, 28% all in was what they said your house can't be more than 28%. Well, it's now 47% of average incomes. And we have this 57% affordability gap to buy an annual house versus what you can actually afford there. And why that's so critical is that first-time home buyers, are the ones that drive retail because they have to buy everything for the home. They have to buy the appliances. They need to buy all the curtains and the paint the house and get it the way they want, couches and all that sort of stuff. So right now we have 4.7 million homes less than we need in the market. Yet we still have 35% more home sellers than buyers due to high interest rates. This is where the Fed comes in again. As Fed lowers rates, this spurs this market. This has a major impact on the economy overall. If they lower rates, that drives other things. Now, my personal view, we'll talk about this, is a lot of the tax cuts that are this year, where we're feeling the pain of the tariffs this year, come into play. Along with, so tax refunds will be larger next year, as well as lower interest rates, which should be a boon for your home improvement retailers like Lowe's and Home Depot next year. But we're talking May and June of next year when we see that big push in big numbers for those guys there. Because once again, home ownership drives throughout the entire retail economy. First-time home buyers are now only 24% of the overall folks that just cannot afford to get into homes. That's a big problem. This is a big issue on the social side, which we don't have time to get into, but also from a retail side. This looks at 30-year-olds who were both married and homeowners, and how that has dropped so dramatically in the last 50, 60 years from where we were. This is really concerning when you look at retail, because once again, when somebody is married and in a home, they're buying other stuff. But this has social ramifications big time as well that we're dealing with in the United States for sure. So just to show you just this dramatic chart, because it really does reflect a lot of the problems we have in our society right now. Just showing that in one chart. So what are some good news? The rates are coming down. There are more people into arms with the bet that rates are going to go down, but this isn't the arms. These aren't the type of loans that you had back in the 2008, 2009. They're very different from what those loans are. I'm not a mortgage expert, but an ARM loan seems like a better approach right now because interest rates are likely to go down, at least for a season. But right now that's freeing up about $200 a month in savings there. And we saw our first big jump in new home sales in August, according to the retail census there. So Fed fund rate, just see where we're at. The market thinks we're going to be. As that comes down, that spurs retail, that spurs investment for all aspects of the, and for businesses as well. So that's a big driver. The biggest issue is consumer sentiment and where the consumer thinks the economy is going, and their confidence in the economy is way, way down. September was 30% change from a year ago into the negative in terms of their view of the economy. And once again, right now we're feeling all the pain, the benefits of those tax cuts and all that sort of stuff. shows up next year. So that's the big challenge on that respect. So consumer sentiment, and the reason I shared this chart is just to show you the concern is the incomes over $100,000. That's 50% of the U.S. economy for consumers or households over $100,000. That's not by population. That's just by money spent in the retail economy. And that sentiment dropped significantly last month. That is the biggest concern here as we wait for the Fed, and then we've got government shutdowns and all that other fun stuff. Do we get into a consumer crisis before we get to something good? That is the part that we've got to take a look at. And this is a concern that we're seeing a drop in the higher incomes. We've had struggles with the lower incomes. And these people are really hurting down in the less than $50,000 range because all the government stimulus funds and all that sort of stuff is long gone, and they just feel inflation right now. They're really struggling. So this is the chart that shows just the percentage of that top 10% that they have in terms of retail clout here. We saw this earlier in terms of a chart for job hoppers, but we actually see the change in wages are down, and everybody's pretty close aligned, that we're sitting here between 3.5% to 5%. So the people that are hurting are the lowest wage earners that got the biggest bump when we had hero pay and other things like that. That's a big deal for stuff related to the economy and consumers. Health insurance premiums going up. The big thing that's happening, though, is all that bad news, this should be negative. And this is retail sales growth year to year. So there's this retail therapy thing that is, I don't have a good explanation for it other than it seems like it's fueled somewhat by debt and somewhat by the higher income folks there. But people continue to buy. This is real credit card data from the CNBC and NRF Monitor related to that. So, and you look at the individual areas, September, once again, the building and garden supply is down year to year. They've been down through the whole summer. This is directly an interest rate area, but you see strong growth in clothing and also digital products happening. Strong growth when it comes to sporting goods and hobbies and things, things that are happening, kids going back to school and stuff like that. And we're continuing to eat out at 4.14% growth in terms of eating out. Now it's slowed a little bit. Americans are addicted to eating out for sure. So holidays real quick. Online shopping is expected to grow dramatically, 520% by Adobe. A lot of people are moving that shopping earlier. So we see that planned start to holiday shopping has already started for many people. And 65% said they plan to start before Black Friday, their holiday shopping for this year. The expectation is about 3% growth, which would be just about inflation when it comes to holiday shopping. So all of that is a precursor. Our study, which is Shelf Intelligence, the revenue imperative for modern retail. So let me just give you some highlights. First of all, IT budgets. AI continues to gobble up more and more of the IT budget. We went from 12% 2 years ago. We're now at 16% of the total IT budgets, and the overall IT budgets have grown probably about 10 to 12% in that same 2-year period. And that's dramatically different for winners versus or leaders versus laggards. When I use that term, leaders and laggards, just for definition, a leader is 10% growth. A laggard is flat or negative growth. And then this is what they're spending there on things. So just so you know that up front when I go through this. And this is where we are seeing a massive difference. The winners, the sales is 10% or more last year, are growing their IT spend. Their IT spend growth is 4 times that of those who are flat or negative in their sales last year. So and that's a bigger base. So what we've got is somebody that's increasing speed in IT versus those who are not. I say me racing Usain, he gets further away and gets faster than I could ever be. And I have a hard time catching up because of this IT side of things. That being said, 87% of retail revenues have a store component. We're seeing dramatic rises in BOPIS, click and collect sales, local store, local delivery, ship from store. happening, particularly in fast-moving consumer goods when it comes to stores. And that's where this shelf intelligence really starts to play into things, because if you don't have accurate inventory, not only can you not sell it, but you lose all the margin by having people wander around the store trying to find the products. Overall, we've got inventory distortion, overstocks, out of stocks, 1.7 trillion. We've got a report on our site that we do every year that's out there on the cost of inventory distortion. That is the the full worldwide loss of sales due to things being out of stock or overstocked during the process. And the disconnect is retailers think they're in stock 92% of the time, but when you interview consumers about what they actually came away with going into your stores, you find that about 70 to 85% of their shopping trips, they leave without at least one item that they plan to buy from that store. And that is a massive problem. And the reason that is so critical is, particularly with the rise of Amazon, is you get into this unvirtuous cycle here, where 80% of US households have Amazon Prime. They spend more on impulse items, and they go to the store. When they go to the store, they go to stores because they expect you to have in stock what they plan to buy. But if they see a stock out on something they plan to buy at your store, they're 73% more likely to just whip out their phone and order it from Amazon. And once they order that item from Amazon, you may have lost them for good. Generally, consumers will give 2.5 to 3 times stock out before they give up on that retail. So approach to technology, about 20% of retailers are early adopters to technology. Another 34% are fast followers. And we'll have some more research on that in a couple of weeks on that piece alone. It's very important to know that profit leaders, the highest profit people out there, are more likely to be early adopters, 94% more likely to be early adopters. So with that, I'm going to invite Christian back on stage to share a little bit about Scandit, who are sponsoring the distribution of this product today.
Super. Thank you for the introduction. So yeah, just a quick recap. My name is Christian Flöckmeyer. I'm the CTO at Scandit. And we are a global leader in smart data capture, originally funded back in 2009, backed by major investors from Warburg Pincus, Atomic, and Google Ventures. We are running at roughly 2,000 customers today, with a really heavy focus on retail. We actually started offering barcode scanning solutions for smartphones back in the 2010s, where this wasn't yet commonplace as today, and evolved over time, powering the largest retailers. And we just did a press release on our collaboration with Walmart, where we're empowering store associate productivity with our smart data capture solutions. What that means overall, while at heart we still consider ourselves sort of a startup scale-up, we are really a proven piece of technology with 150 million of active devices and billions of scans each year, driving crucial processes within retail, transportation, logistics, and manufacturing. Maybe you can flick to the next slide here, because I don't see oh, there we go, I can do it myself. Super, thank you. Maybe just going back one step, we started off on the barcode scanning side, as I mentioned, and powering barcode scanning based process within retailers meant powering gap scanning, powering price checks, powering top stock replenishment processes. And we noticed while we provided fast and reliable technology to do that, this wasn't a very convenient and efficient operation for the store associates, right? While over technology over the last 10, 20 years, it got better and better, and barcode scanning got faster and faster, the fundamental process actually didn't change. It was still the same. You scanned the label of them where there was a gap. You checked the price by scanning the barcode label on the shelf and typing in the price. Very monotonous, very tedious tasks that are carried out in a non-unified way. And we started looking at saying, can't we, with the advances in AI and computer vision, can't we change this? And the product I want to go and talk to you about today, and showing a little bit like our lessons learned along the way, is called ShelfView. And our ShelfView product does exactly what I mentioned earlier, right? It incorporates barcode scanning, so scanning the labels, text recognition to scan the prices on the labels and description, and then object and image recognition to identify the products based on their packaging material and see, are the right products in the right spot? Are they being sold at the right price? And are they in the right spots, or are they even on the shelf in the first place? And within Scandit, we've had for the longest time a debate around what's the best hardware to actually do this? When we started off a couple of years ago, we started with doing this with robots. And, thinking behind this is, yes, you could do barcode scanning. In the past you did this. The store associate do this. Why not eliminate the entire capture from the store associate and put these autonomous robots into the stores and capture this information, and the store associate only acts on it. And that has obvious advantages from capture costs being low. But we fairly quickly realized that didn't seem like the optimum solution either for many retailers, because while it was a good solution when they were large, even the larger stores had areas of the store that were difficult to go and reach with robots. So you definitely needed like a hybrid approach combining with mobile capture. Large retail chains also had smaller store formats where robots just weren't very attractive from a cost perspective. So you wanted to go and just operate with mobile devices. And then there were maybe certain areas of the store where you wanted to go and look very, very frequently, and you wanted to go and operate with fixed cameras, right? So in our sort of quest to find what's the best hardware, we realized there isn't one, and it really needs a mix of technologies. And this is why when you look at our Shelf View platform today, we really offer a hybrid data capture approach, not set to one particular hardware platform and locking retailers in on that hardware platform, but provide an overarching software platform that is compatible with a whole range of different hardware data capture formats. And to illustrate this point a little bit is you can go and look at this in very many different dimensions. I've only listed 2 here. There's many more. And one way to go and look at those is what's the best way to go and capture a store is to go and look at okay, so how many SKUs am I actually serving in this store? Very large stores having 50, 60, maybe even 70,000 SKUs on display at a time. And then looking at how often do I actually want to go and look at the shelves? You're seeing over here, if you just look at these 2 factors, you are seeing what you would expect. Robots are great and really give you a very good return on investment when you look at large stores where you want to go and look on a fairly regular basis. Mobile capture, on the other hand, if you're operating in smaller stores, and especially if you don't intend to go and observe your shelves on a very ongoing basis, but saying, hey, you're doing a check once or a couple of times a week to really detect these outliers that are not being captured by your POS systems and the other regular processes you have in the store. If that's sufficient, then mobile capture is actually when you look at only these 2 factors, a very attractive option. And then you're also seeing if you're intending, and you're seeing in your business processes that a very high sampling frequency, where you're looking very often on the shelves and you can really generate value out of these frequent scans, then suddenly the fixed and shelf-mounted cameras are best. Of course, this makes certain assumptions about cost of the robots, cost of the devices, right? But overall, I think that it paints a picture that shows that it's depending on your setup, and especially when there's mixed deployments, you really also need a mix of technologies to operate at the most attractive operating point. What we've also seen is that it is really crucial to go and support not just one use case, but multiple ones. Early on, when we started, we were thinking from a lean product perspective. We start with one use case, but it became very, very clear that retailers really wanted this unified perspective, shelf availability, price compliance, and planogram compliance, to really ensure that the right number of facings per SKUs are visible, right? And really to do away with what I think is the traditional process today, right? There's a price compliance process where every week or every month, a certain number of 5,000, 10,000 SKUs are being selected, and the store associate walks up and just checks the price levels. And then on-shelf availability process that is typically more run on a daily or at least cycle count, twice, 3 times a week basis. And then a planogram compliance that really depends on the retailer, sometimes only being executed once a quarter. And every single time, these are different people with different tools, sometimes pen and paper that do this. And the promise of AI-powered shelf intelligence and of our product as well over here, you do really do away with this and have a single unified perspective onto your shelves that you at all times know what's on your shelves so that you can optimally steer your store associates to fix pricing issues, to address promotion challenges, and to restock. So that's in a nutshell also what the Scannet platform provides in terms of feasibility. I think the key question, and I think it aligns with what Greg mentioned earlier, right? There's no point, and we always say this to our customers, look, is having visibility is great. If you don't see a way that you can go and act on it, and that actually drives real value, then we would rather not work with you, and we'd rather not even deploy this, because at the end of the day, these deployments will fail. what we've seen, and here's a snapshot of this, is that we're typically seeing sort of on-shelf availabilities anywhere between 90 and 97 to 98%. We hardly ever see a retailer that is below the 90% when we go in. We are seeing that the retailers that actually operate at very high on-shelf availability rates typically spend significant labor costs on achieving this and are keen to actually arrive at on-shelf availability that is at lower cost. And what we are seeing when we go in and do an audit with our technology on what on-shelf availability increase is actually possible, we typically seeing that just based on what's available at the time in the back of the house, you can get increases in the range of anywhere between 3 and 6%. In this particular case, it was 4.5% that we could drive up on-shelf availability. And really the key point is, if the product is not in the back room and is somewhere not available in the supply chain or hasn't been delivered, I can't drive our on-shelf availability up even if I see there's a gap. So we can really only act on those items where there is stock available in the back room. This availability to the 75%, we typically are seeing that at least in the large grocery chains where there is significant sized back rooms, that is as high as 75% of the items that are actually missing on the shelves are available in the back room, right? And it really shows the challenge with labor availability, prioritization to go and drive higher on shelf. I'll move to the next slide to talk a little bit like how we typically deploy, right? And I think this comes back to what Greg mentioned earlier as well, is I can tell you at Scandit, we very much sort of a deep tech scale up. And there were times where we went to market very much with like, look, this is technology, this is innovation. And we've seen that, especially in the shelf intelligence space, we've changed our approach, right? So really the focus is that we come in as in our engagement, we typically say, look, let's assess what is your focus at the outset. Is it on-shelf availability? Is it to drive up planogram compliance? Is it price integrity? Or is it all three of them at the same time? Then look at these KPIs, set a baseline of what we expect, and then we typically come in and run a pilot, a couple of stores, 80, 70% coverage of the store, but no execution with store associates involved at this point. Really just to build a baseline of what the metrics look like. This gives a way to prove the technology, right? Like, which we do know is work, but it's always important for you as a retailer to get the same impression. But more importantly, we actually have a baseline of what is your on-shelf availability? What is your price compliance? And that's the fundamental baseline to actually build a business case and then roll out. So as we said in that pilot, we built the baseline from a business perspective. And then the next step is to go and say, look, and we typically do this with mobile capture. It's very easy to deploy, easy to get out there. And then as a second step, there's the option to decide on the best data capture method, as I mentioned earlier, to really scale that best path for ROI and potentially look at other revenue streams like monetizing the data for CPGs, which when you think about this, right, it's an inherent ineffective way today where CPGs send folks into the stores to have a look at what's actually available on the shelf. If you're having these technologies deployed at scale, leveraging these data and selling them on to the CPGs is a very attractive revenue stream, and be providing this with our stack. And overall, what this approach of setting the priorities, piloting, understanding their baseline, and then scaling and acting on the data shows is it provides you a very straightforward way to really prove value. Here's an example from one of these pilots that we've been running. You see 2 stores. You see on the x-axis, you see the days. On the y-axis, you see the on-shelf availability that we measured. And as part of this assessment that we're doing, you're getting a very accurate measure of how is your on-shelf availability developing over these days, how also different stores operating differently. You can determine what is your best sampling frequency. In this case, we actually looked at the shelves every day. You could go and argue that that's actually not necessary. So you're spending time on analyzing shelves that is not necessary. And these assessments also allow you then to go and drive an on-shelf availability by category so that you can decide where you want your workforce to invest in restocking. You might not decide that in certain areas it's worth restocking given that the margins are low and it doesn't impact on-shelf availability much or customer loyalty. And in other areas, you might want to go and decide that you deploy your store associates in a much more focused way to really drive up on-shelf availability. These are then the sort of business discussions to be discussed with the individual stakeholders on how to roll this out. So this was a quick overview of our shelf view product. from my perspective, the highlight was about hybrid data capture, where we bring in not just one hardware technology to capture the information, but supporting a whole multiple of from fixed cameras, robots, and mobile cameras to capture the state of the store. And then highlighting to you a little bit like, while it's definitely technology innovation to actually capture the shelves and digitize them, the real key point is around establishing these business metrics that fundamentally drive the deployment of the technology in this.
All right. Thanks, Christian. Thanks so much. Hey, guys, we are going to do rapid fire here because we're behind and I had things. So wanted to share the slides with you so you can get the slides and the research report as I finish up and get to the heart of the study. So main thing here is profit leaders are prioritizing the inventory visibility at a level that's 208% higher than the laggards are. We literally are seeing massive changes of what's happening between leaders and laggards when it comes to this data. Those sales winners are prioritizing the cleaning of their data at a level 100% higher than the laggards are as well. So once again, that race keeps going forward more and more. Those that choose two or more approaches to their data capture, as Christian showed, whether it was a mobile phone or a robot in the store or using fixed cameras, etc. Those people that use two approaches are 136% more likely to be profit leaders this year as well as last year in our research, growing their profits at 10% a year. It goes to show when you have 87% of your fulfillment coming from a store, knowing what you actually have in the store makes a big difference. And, whether it's BOPIS, click and collect, et cetera, that profitability is all there. People where they are with things, computer vision adoption, massive move towards computer vision here in the next 12 to 24 months. Overall, this is a massive area investment, done several webinars on that this year. And once again, the people that are, early adopters in the hybrid data, capture, the people that do hybrid data capture are 64% more likely to be the early adopters. And as we shared with that, the early adopters are highly correlated to sales winners and profit winners overall from that data, which is getting to that clear picture that the sales and profit winners are continuing to extend their leads by compounding the advantages over time of their investments. It's not just a single event or an investment. And one of the things in the data that is most concerning is when we see laggards say, oh, we're going to do this huge investment in AI, but we haven't done the work to get the clean, accurate data. That's just a recipe for disaster as people are going to go out of business faster because they're putting AI on bad data. And that's a big thing that's showing that if you do that hard work, clean your data, then you put AI and all these great tools on top of it, you're extending your lead. And as we mentioned earlier, the profit winners were growing, sales winners were growing their IT spend faster, but profit winners growing their IT spend 7 times faster than the laggards, and they're growing their store IT investment nearly 5 times higher. So their growth rate in spend, once again on a higher base, okay, is still 7 times more than those. So it is literally a race, and this race could be over if folks haven't invested in their technology stacks going forward. Investment in the next 12 months, hybrid data capture 36%, smart shelves 31% here. These are individual technologies versus combined technologies. Massive adoption of these intelligent technologies in the next 12 months for retailers. One of the findings that we found is the people that use hybrid, use multiple things, their actual revenue, percentage of their revenue that comes from BOPIS and comes from ship from store, which are two journeys for customers that can go negative real quick for a retailer because you're using store labor to do that. Those people that are using a hybrid data capture strategy are seeing much more growth in those sectors. So much higher percentage of their total revenue is coming from these alternate channels than the walk-in store. This is particularly advantageous for those that have a lot of inner city stores where so much of the merchandise is locked up for security reasons. The people that are data capture technology are seeing these alternate distributions and pickup and shipping, seeing massive growth in those areas as they get better data intelligence there. So benefits, customer sat was the #1 benefit that is done here. Reducing the labor cost improving the price and the promotion, the on-shelf availability, as well as the promotional compliance. And then as we're see later, actually in a much bigger way in about 2 weeks, the data monetization with brands and improving the brand relationship by the better data that you get, the more you can get from your CPG companies, better partnerships and better terms related to that. Planogram compliance is a benefit, 118% higher than laggards there. The data monetization, once again, is the people there say is a benefit, 99% more likely to have deployed hybrid data capture, multiple solutions as a result there as well. And finally, the profit leaders that are using AI for operational efficiency because they've got better show intelligence and better ground truth, they're 300% more likely to maintain that profit leadership year to year. Once again, nothing beats clean data. And those with the best data wins. And with that, we're going to invite you, Carl, back on stage. We're going to start with Q&A. I already put the slides and the report out there. If you want to download those, certainly we're going to email you that link as well for that. But before we get to Q&A there, I want to invite everybody to join us for Super Saturday to help kids at NRF. If you're going to NRF Super Saturday, it's free for every retailer. And you actually guys drive vendor involvement. So every retailer is worth clean water for 500 people by just showing up. And so this is huge. Our next 3 weeks are a major critical period for this. Come help a lot of kids. It's a unique day, fun day. Please join us. Okay, Carl, what do you got?
Before I actually get to questions, just a quick reminder, this seminar and the slides are both being hosted on the YHL website and Scandit's website. So please feel free to download that and tell your friends about it. Sarah asked the question, what has happened to technology, Christian, in the last few years that have made shelf intelligence so viable, such as AI or other technologies?
Yeah, that's a very good question. I think there's a couple of things, right? I think the key point is the advances in computer vision and AI that led to an overall increase in your accuracy rates, right? At the end of the day, I think we all know, right? Just like if you deliver technology that delivers, I don't know, every third alert is wrong, then this is just not being adopted. And I think this has changed. With the advances in computer vision AI, we've also seen internally like real improvements in the algorithms that allow you to scan barcodes at really long range, identify products accurately from a like-looking product. So I think that has been definitely one of the big advances that made this possible. I think there's another element on that data capture technology has gotten better, right? Like high-end cameras that provide in low light settings, sharp images. I think that has improved, but it's not the major driver. It's really on the computer vision side of things where the advances on the AI side have made a real big impact.
Christian, Peter asked, what data do you perceive CPG would use and how frequently should they get that data?
Look, I think I'll start answering that question arguing the other way around, right? Like how frequently are they getting the data today? And this is really being driven by the cost of having field forces in the store and the cost of getting the data, right? Which means that the data points are being only collected in the largest of stores because only that is economical to capture. It's typically being acquired sort of on a month, maybe on a quarterly basis, where the average store is being visited, large store, hypermarket is being visited about 15 to 16 times per year. That is not driven by the data that they would like, but that's driven by what is economical. So, you turn this around and you look at if shelf intelligence at the levels we suggested here, where you typically operate with a capture frequency anywhere between daily to every other day or twice a week, you by definition have a much higher granularity in your data points. And you also have in the temporal and the spatial domain, you have a much higher resolution, meaning that you capture data more often and you also do it across many more different store formats, right? And capturing this data comes as a byprocess of keeping your shelves replenished. So at the end of the day, the data is available at a higher frequency. Now, at what frequency does it make sense for the CPGs? I think this is really something that depends exactly on the product, on how often it's being sold. Some actually benefit from this much higher frequency, others don't need it. But I think overall, it's the higher sampling frequency that the integration into retailer workflows allows just has benefits downstream, right? And since it comes with zero added costs, it's really up to the CPG to go and decide at which frequency they want to go and consume those.
Economically, Lee asked the question, what segments are getting hurt the most from today's shutdown of the government?
Right now, the biggest, from the shutdown, the biggest segments are restaurants, local restaurants and large government areas. That's the biggest, but also restaurants, sit-down restaurants in particular. You don't have a lot of lobbying when the government shut down either. So those are the two areas getting the biggest impact immediately, and that doesn't necessarily come back. And same with grocery, a lot of trading down in grocery stores to generic brands versus maybe brands as well there. The shutdown happened after the back to school season. So as long as that is, done here soon, it won't impact Christmas for clothing. I think where you will see a change this year, though, is about 40% of all Christmas spend is you buying for yourself. And I think that part of the holiday spend will be impacted because of the government shutdown and just tariffs and other things in the economy. But the needs and all that stuff, how big your Thanksgiving dinner is going to be, your holiday dinners, I don't think that's going to be impacted at all.
In follow-up, what segments will be best positioned in 2026?
Well, 2026, as I mentioned, home improvement is set up for a big gain in 2026. I think your hard goods overall, in general, the opportunities with Windows, people need to start getting new PCs, whether or not they do that by the end of the year when they move to Macs, that sort of thing. As AI continues to be just driven down to a local unit basis, you may see more phones be sold, driving up that electronic space. Furniture is probably poised to grow related to the home improvement space as people move and sell more homes, and they move their homes, et cetera, choosing not to move their existing appliances and furniture as they move. So those are the ones that I think will benefit the most next year.
Christian, Jerry asked, do you see the differences in retail subverticals in the way they approach the measuring of shelf intelligent solutions, i.e. grocery versus mass merchants, hardware, home improvement?
I think it's slightly different focus. For example, when you look at grocery, we are seeing at this point a real focus on on-shelf availability and price compliance and promotion compliance. In the DIY space we are seeing a much bigger focus on planogram compliance, really driven by there's very little visibility what is actually, being stored where. And we've seen in some of the trials we've done planogram compliance that is down to like 60, 70%. Of course, depends exactly on your metric there, but like really to the surprise of the DIY store operators. So I think that there's many differences between different subverticals, but that's one of them that I would go and call out between DIY and grocery. So
for a final question, how do you see shelf intelligence maturing further in the next couple of years, including retailer adoption?
Look, I just look at this. If you just look from a fundamental perspective, right? Like we've had these processes in retail, and whether what I mentioned earlier, barcode scanning, price checks, still with pen and paper today, and fundamentally there is technology that is capable of replacing this, and I think down the line, just the economics will drive this. Just like it's very common for us to use mobile phones, that wasn't the case 10, 20 years ago. We'll see this will become much more commonplace. Where the return on investment justifies it, we will start seeing more autonomous deployments, especially fixed cameras and robots. In other cases, especially when you want to empower the store associate, we'll keep seeing the store associate very much in the loop and being in charge of it. But I think what we are seeing down the line is that in some way these archaic processes will move to like a more modern set technology.
Yeah, I think we're at a massive inflection point that already started really in terms of shelf intelligence, in the fact that the cost curve for these technologies has dropped dramatically to be able to deploy them effectively. And the benefits, because of you get to clean data, that you can take advantage of that information from an AI perspective, is going to have a massive increase in terms of the improvement of the intelligence that retailers can use and act upon at the store level. I heard a statement this morning that sounds like a good one to end on. We have certain technologies, and I'll equate this to AI as an example, but it's just the difference between incremental benefits and innovation. There are some people that are deploying AI on existing processes there, and they'll get incremental benefits. And there are others that are deploying AI by rethinking the entire process. And those people are getting innovation, true innovation, and those are 200 to 300% improvements or higher as a result. And I think shelf intelligence is one of those things where we've had such a huge advancement that retailers really should start rethinking their entire processes of how they do things if they want to see the huge benefits. You can get those incremental benefits there by deploying this, but it's time to start rethinking your entire process as these technologies come down in price and become more effective and reliable, because those people are going to be able to see the greatest growth and the greatest reduce in product expenses at the retail level. And it's going to be this jump in technology that we're going to see. So with that, guys, hey, sorry we went a little bit over. That was my fault. I went too long on the economy stuff there, but thank you so much for joining us today. Appreciate ScanIt once again for making this content available to you. Give us some feedback there, download the slides. Our next one will be November 5th, where we'll go specifically into robotics and automated intelligence in more detail. So we're very thankful for ScanIt. Thank you guys. Have a great week, rest of your week and weekend. And if we can help in any way, let us know. You can find us on LinkedIn or through our email addresses there, which would just be christian@scanit.com or greg@ihlservices.com. Appreciate you guys spending time with us today. Thank you.